Well, out this morning was the jobs report for December, and pretty much a whole hum number, 155,000 new jobs. It's good that we're producing new jobs. That's a positive sign, but it's not so great, and that's been the average. We can't seem to, 155,000 jobs is not a very good number from a recovery from a recession. We've never had very good numbers. It's not even enough jobs to put the people back to work entering the workforce, put the people to work that enter the workforce, let alone put to work to those people that were laid off or fired. And this is one of the weakest recoveries from a recession. Remember, the recession is back now. We got to go all the way back to 2008. And here it is at the beginning of 2013. We just have not been able to produce a lot of jobs. The result is the economy is not going to grow very strong, and the stock market is going to probably struggle. I mean, I think it'll do well in 2013, but I don't expect it to do that well. We had a good 2012. The stock market was up decently. We also, for our clients out there, we also had a good year in all of our clients, all of our managed accounts. So that was good. Going into the new year, we probably see a continuation of the rally. But there's going to be that fiscal cliff in 2 months, so we're going to go through another volatile time. There probably will be some kind of resolution, but isn't there always something to worry about? Always is. So, anyways, this week we had some good numbers. Construction spending was expected to be +0.6%. It was down 0.3, which was not a good situation. But the ISM number, the manufacturing ISM number, came in better than expected at 50.7. It's supposed to be 50.3. That was the expectation. Last month it was 49.5. So it seems like the economy is still picking up a little bit of steam. That was the manufacturing ISM. Today, later on this morning, we'll have the service sector ISM, which has always been above 50. So hopefully we'll see it still being above 50. That's the expectation. Above 50 means expansion in the economy. So we have to stay with the market. You're going to have to stay with the market. As I told you before, the Congress was and the president were going to solve the fiscal cliff issue, and I've said that they were probably going to agree on something, which they did. Taxes on anybody making $450,000 are going up. In actuality, it's taxes for everybody's going up because the reduction of your Social Security tax that was temporary it has expired, and so that's going back up to what it was normally. I think from 4% to 6 something percent. So everybody's taxes are going up a couple percentage points. But for the rich, or quote unquote the rich, anybody making $450,000 or above is going to have a higher tax rate. Below that, no. Capital gains tax are going to go up from 15 to 20%. Unless you make a lot of money, then it's going to go up to 23.6%. It goes up more. So that's what you're looking at. You're looking at higher taxes and no agreement on lower spending. Now, why is the lower spending important? Well, it's not necessarily lower spending. It's the deficit. It's the bond market looking at us borrowing more and more and more money. What is going to happen with interest rates? Yeah, the Fed is doing everything it can to keep interest rates low. It's buying bonds. It's buying the bonds to keep the interest rates low. What happens when they stop buying bonds? And in the minutes from the Federal Reserve, this most recent meeting said that 2013, sometime they're going to stop buying the bonds. What do you think interest rates are going to do? They're the biggest buyer of bonds right now. When we issue bonds, when the government issue bonds, someone has to buy them. And how they buy them is they bid on what interest rates are willing to accept. You think they're going to continue accepting low interest rates? Not when the government stops buying them, because the private sector is going to say, we want more return. Interest rates are probably going to rise. I just can't tell you when. When it does, our borrowing cost for the government goes up. Our financial quality of our country will go down. They'll probably be downgraded again by Moody's or somebody else. Standard & Poor's and Moody's will probably be downgraded again. We're AAA. We were AAA plus. We're AAA plus. I don't know. Just a downgrade by a tick. We'll probably get downgraded another tick. As those downgrades come, interest rates rise, and we're looking at borrowing like Greece at some point. Unless we can get ahead, there's two ways we can do this: cut down spending, or really spark economic growth to support the spending and quit increasing the spending. If we spark economic growth, great, but you show me where that's going to happen. I don't think so. I don't. So, but the stock market, I don't know if you can see the chart behind me. That's a weekly chart of the S&P 500. Is making higher lows and higher highs. As long as it keeps doing that, we're in a rally. And this is from 2009 low. And it looks like that's what we're doing. At some point, maybe when we reach the 2007 highs of the market then will have a correction, a deep correction. That may not be this year. Could be, but I'm more fearful of 2014. But that's a lifetime away. We don't have to worry about that yet.
The Invest Talk Update is a monthly briefing that gives you a snapshot of the past month's market, along with other useful perspective and information. You'll see important articles like Protecting Your Investments Against Scam Artists, excerpts from Steve's book, links to the month's Invest Talk talking points, plus news of upcoming Invest Talk events in your area. And it comes free each month to your email box. To get your subscription, just go to investtalk.com and click on the icon at the top of the page.